Ladies and gentlemen, Asian Guy here, and what I'm about to reveal will shock you to your core. I just spoke with a bullion dealer who experienced something unprecedented in precious metals history. In the first 20 minutes after opening on Friday morning, his entire bullion showcase was completely wiped out. Not partially sold, completely empty. And this happened during silver's biggest single-day drop in dollar terms ever recorded. Let me repeat that because it's so important. Silver crashed harder than it ever has before, and physical demand exploded to levels that literally emptied dealer inventories in minutes. That's not normal market behavior. That's a signal of something massive happening beneath the surface. But here's what makes this absolutely mind-blowing. While paper silver was crashing from $100 to $72, smart money was backing up trucks to buy physical metal at fire sale prices. One customer walked in Friday morning with a $25,000 cashier's check and said, "I'll just take whatever you have." He cleaned out a major portion of the dealer's inventory in a single transaction. This is the great divergence playing out in real time, and if you don't understand what's happening, you're about to miss the most significant wealth transfer in precious metals history. The dealer I spoke with has been in this business for decades, and he's never seen anything like this. "The stackers that come here are very smart," he told me. "They bought on the dip and utterly wiped us out." But here's the kicker. They're buying everything available, and then waiting for new inventory to arrive so they can buy that too. Picture this scene. Customers literally milling around the shop, waiting for the dealer to complete purchase transactions from sellers so they can immediately buy whatever just came in. The dealer has to tell eager buyers, "Hang on, it's not ours yet, be patient." That's not normal retail demand. That's panic buying disguised as opportunistic accumulation. The inventory situation has become so extreme that showcases normally packed with silver eagles, rounds, and bars are sitting completely empty. End sections of display cases have nothing in them. Even the numismatic cases holding collectible silver coins are being cleaned out by buyers who don't care about premiums anymore. They just want silver in any form. But here's what reveals the true magnitude of this demand explosion. They're buying constantly throughout the day, not just during the morning rush. The dealer explained, "It looks like we haven't bought anything since Friday, but on the contrary, we're constantly buying all day long. People are buying it out from under us. We're not being able to fill the showcase. We're selling it in the moment." Think about the mathematical implications. A major coin shop is buying silver inventory continuously throughout business hours, and demand is so intense that the inventory sells immediately upon arrival. That means demand is outpacing supply in real time at the retail level, creating shortages that cascade through the entire distribution chain. The customer demographics reveal something equally important about this demand surge. The dealer reported seeing a lot of new faces, people walking in saying, "I don't know anything about this, but I want to invest in silver." These aren't experienced stackers timing the market perfectly. These are mainstream investors who finally got scared enough to seek real assets. When precious metals hit mainstream media consciousness, it triggers a psychological shift from curiosity to urgency. The dealer mentioned relatives texting him about silver, people who don't even know what he does for a living suddenly asking about precious metals. That's the moment when retail FOMO transitions from early adopters to mass market participation. But here's where the story gets really interesting from a market structure perspective. While generic bullion inventory disappears immediately, 90% constitutional silver, pre-1965 dimes and quarters, remains relatively available. The dealer explained why. The people with big money, the real high-volume whales, are buying bullion, and not the 90% for the most part. This creates a two-tier market where sophisticated buyers with large capital focus on pure bullion for mathematical simplicity, while smaller investors and collectors pick through constitutional silver. The arithmetic difference matters psychologically. Full ounces are easier to calculate than the 0.715 troy ounces in each dollar of constitutional silver. The refiner situation adds another layer of complexity to this supply crisis. Major refiners have stopped buying 90% constitutional silver entirely, and many coin shops have also stopped purchasing it. This creates artificial scarcity in the wholesale market that forces dealers to be extremely selective about inventory categories. When refiners refuse to buy certain types of silver, it means the recycling loop that normally brings metal back to market gets broken. Constitutional silver that would normally be refined and recast into bullion bars stays locked in collector markets, reducing available supply for industrial and investment demand. The new COMEX 100-ounce silver futures contract adds another manipulation tool to the paper market arsenal. Currently, the standard contract size is 5,000 ounces, which requires significant capital to trade. By offering 100-ounce contracts, they're making it easier for more participants to trade paper silver, but also easier to manipulate prices through smaller contract flooding. The dealer's analysis was blunt. I don't think they're doing it to benefit the stackers. When you can manipulate markets with smaller position sizes, you can pick your spots more precisely and execute more frequent interventions to control price discovery. But here's what the paper market manipulators didn't anticipate: physical demand that completely ignores paper price signals. When silver crashed from $100 to $72 on paper, physical buyers treated it as a clearance sale, not a fundamental change in silver's value proposition. The JP Morgan short covering at the bottom proves sophisticated manipulation continues, but it also reveals desperation. After years of building massive short positions to suppress prices, they're finally covering those shorts during orchestrated crashes. That's not confident market making. That's strategic exit planning. The psychological dynamics driving this demand are fascinating and sustainable. Regular customers are bringing friends and neighbors to introduce them to precious metals. The dealer described it as giving them the bug, converting people to understand that silver and gold have been money for thousands of years and continue to be reliable assets. This word-of-mouth evangelism creates exponential demand growth that's much more sustainable than media-driven FOMO. When existing customers become advocates who bring new customers, it builds a community of buyers rather than just individual transactions. The price trajectory analysis from the dealer provides crucial context for understanding where silver goes next. Despite the dramatic crash from recent highs, silver is trading around $88, $89, which he pointed out is hardly a low price. We're down at a very high level. The mathematical perspective is critical. Silver started the year at $71 and briefly touched $100 plus levels. A pullback to $88 represents normal volatility within a strong uptrend, not a bear market reversal. The dealer noted that silver is still the best performing asset of the year, even after the correction. The $150 price target timeline remains intact according to the dealer's analysis. Look at the kind of jumps: $9.40 in a day. 4 or 5 more days of that and you're there. When silver moves with gold-like volatility in dollar terms, the arithmetic to much higher prices becomes straightforward. The geopolitical catalyst scenario adds urgency to this timeline. With the Abraham Lincoln Aircraft Carrier Group positioned off Iran's coast, military action could trigger immediate precious metals spikes. All it would take is a little firepower off the coast of Iran and we're there, the dealer explained. The psychological barrier analysis suggests $150 silver is more achievable now than before the recent price action. Many buyers have already experienced $100 plus silver prices, making them psychologically comfortable with triple-digit silver. That comfort level reduces resistance to higher price levels when momentum returns. The supply constraint indicators are accelerating rather than moderating. Constitutional silver availability contrasts sharply with bullion scarcity, but even numismatic silver is being purchased by investors who don't care about collector premiums. When investors start buying silver in any available form, regardless of traditional pricing structures, it signals true supply shortage. The dollar-cost averaging strategy becomes more important in this volatile environment. The dealer emphasized, no matter what silver is doing, always buy through systematic accumulation, rather than trying to time perfect entry points. When physical shortages can develop overnight, consistent purchasing ensures access to available inventory. The dealer's business model adaptation reveals how severe the supply-demand imbalance has become. Instead of maintaining showcase inventory for browsing customers, they're operating more like an order fulfillment center, where inventory sells immediately upon arrival. That's a fundamental shift from retail to rationing. The profit-taking dynamics during the crash created temporary relief for dealers, but also revealed the strength of underlying demand. People who held silver for even short periods were profitable and took some gains, but that selling was immediately absorbed by new buyers who view any price decline as opportunity. The organic nature of this bull market differs significantly from the 1979-80 Hunt Brothers manipulation. Instead of a single entity trying to corner silver markets, we have distributed global demand from industrial users, investors, and governments simultaneously competing for limited supplies. That demand diversity makes the trend much more sustainable. The manipulation tactics are becoming less effective as physical markets diverge from paper prices. While JP Morgan and others can still create dramatic paper price moves, Physical demand treats those moves as buying opportunities rather than fundamental shifts in silver's value proposition. This is Asian Guy, and the bullion dealer shortage story reveals we're transitioning from paper price discovery to physical scarcity pricing. When dealers can't maintain inventory despite continuous restocking, when customers wait for new arrivals to buy immediately, when $25,000 orders get filled instantly, these are signals of a market structure breakdown that favors physical holders over paper traders. The next phase won't be driven by technical analysis or futures market manipulation. It will be driven by the simple mathematics of supply and demand, where industrial necessity meets investment panic, while mining production remains constrained by geological reality. Your window to secure physical silver at current availability levels is measured in weeks, not months.